Against the backdrop of escalating geopolitical tensions in the Middle East, the global energy landscape has been thrown into turmoil, with the Strait of Hormuz, through which approximately 20% of the world's oil is transported, becoming a focal point of uncertainty. For New Zealand, a country 100% dependent on imported oil and petroleum products, this crisis has triggered a chain reaction that extends far beyond rising fuel prices, permeating every corner of its economy, from small and medium-sized enterprises, SMEs, to large corporations, from household budgets to national inflation forecasts. This analysis delves into the multifaceted impacts of the oil crisis on New Zealand, exploring how supply chain disruptions, industry pressures, and government responses are shaping the nation's economic trajectory amid unprecedented uncertainty. Supply chain disruptions. The plastic industry at the epicenter. New Zealand's plastic industry, a critical backbone supporting agriculture, construction, healthcare, and consumer goods sectors, is currently facing an existential threat due to the oil crisis. Unlike many other countries, New Zealand does not produce any plastic raw materials domestically, relying entirely on imports primarily from Asia and North America, according to the New Zealand Plastics Industry Association. The industry, which comprises over 300 companies, employs approximately 9,000 people, and generates an annual revenue of around $2 billion New Zealand dollars, is now grappling with severe supply chain bottlenecks driven by the Middle East conflict and the resulting volatility in global oil markets. Bonson, a New Zealand-based manufacturer of disposable takeout containers, bowls, and food storage solutions, is a microcosm of the challenges facing the industry. The company produces a range of products using materials including polypropylene, PET, PLA bioplastics, as well as sustainable alternatives like sugarcane and paper, serving major clients such as Foodstuffs, one of New Zealand's largest supermarket chains, and Fonterra, the global dairy giant. For Bonson, the supply chain crisis has become a daily reality, with its operations increasingly constrained by the unavailability of key raw materials. The feedback we're getting from our suppliers is essentially that no one is taking orders, said Bennett, a representative from Bonson, in an interview. Most of our materials come from Southeast Asia, and right now, there are no order confirmations, no clear supply information, nothing. It's an unprecedented level of uncertainty. This sentiment echoes across the industry, as suppliers in Southeast Asia, a major source of plastic raw materials for New Zealand, struggle to fulfill orders amid global supply chain chaos and rising production costs linked to oil price hikes. To mitigate these risks, Bonson has taken proactive measures, locking in material supplies for the next 5 months, a significant extension from its usual 2 to 3 month inventory cycle. We started stockpiling as soon as we heard whispers of supply issues, Bennett explained. Some of our core materials come from Australia, which is currently stable, but the upstream raw materials for those supplies still depend on the Middle East, so there's still uncertainty hanging over us. This dual reliance, on relatively stable regional suppliers but volatile global upstream markets, highlights the fragility of New Zealand's plastic supply chain, even for companies that have taken preventive action. Bennett further noted that Bonson is not alone in its struggle, with many procurement teams across New Zealand attempting to find alternative supply routes to bypass the most affected regions. I think a lot of buyers like us are trying to detour, but if the conflict drags on for a long time, we'll be in a very difficult position, he warned. Suppliers are also exploring alternative sources from regions like the United States, but this comes with its own set of challenges: longer supply chains, higher transportation costs, and increased risks of delays or further disruptions. The longer the situation lasts, the greater the uncertainty becomes, Bennett emphasized, underscoring the industry's vulnerability to prolonged geopolitical tensions. The impact of these supply chain disruptions extends far beyond Bonson, affecting some of New Zealand's largest corporations. Fletcher Building, a leading construction and infrastructure company, A2 Milk, a major dairy exporter, and Fonterra all rely heavily on imported plastic packaging for their operations. Fletcher Building has stated that it is continuously monitoring the situation, noting that the full impact is difficult to assess at present, but it will take measures to ensure supply if a major disruption occurs. For dairy companies like A2 Milk and Fonterra, plastic packaging is essential for preserving and transporting their products, making any shortage a direct threat to their ability to export and meet domestic demand. The New Zealand Plastics Industry Association has warned that the ongoing supply chain issues could have far-reaching consequences for the broader economy. With the industry serving critical sectors such as agriculture, which relies on plastic films for crop protection, construction, plastic pipes, windows, and insulation, and healthcare, disposable plastic consumables. A prolonged shortage of plastic raw materials could disrupt production across multiple industries, leading to job losses and reduced economic activity. Point 2. Government response. Navigating fuel supply risks and policy dilemmas. As the oil crisis unfolds, the New Zealand government has been forced to confront a series of complex challenges, balancing the need to protect consumers and businesses with the realities of global energy markets. In a recent update on the Iranian situation, Finance Minister Nicola Willis acknowledged that while fuel supply is a top concern, the government is also grappling with other critical supply chain issues, including access to fertilizers, asphalt, and plastics, all of which are heavily dependent on oil and petroleum products. Willis noted that the Ministry for Primary Industries has confirmed that New Zealand's major agricultural exporters rely on adequate packaging inventories to export their products. They have indicated that inventories for the next few weeks to months are sufficient, but officials are currently checking in with small and medium-sized enterprises and continuing to engage with exporters to understand their key needs, she said. This reassurance, however, is tempered by the recognition that the situation is fluid, and inventory levels could quickly deteriorate if the conflict in the Middle East persists or escalates. A key concern for the government is the potential need to upgrade New Zealand's National Fuel Plan response level. Currently, the plan is at Level 1, which denotes a minor impact with no significant disruptions to fuel supply. However, Willis has warned that the country may need to upgrade to Level 2 within the next month, depending on developments in the Middle East. Level 2, classified as a moderate impact, would mean that most people can still access fuel, but critical users, such as emergency services, healthcare providers, and essential infrastructure operators, may face shortages. In such a scenario, the government would prioritize fuel supply for these critical users, potentially establishing dedicated refueling points or on-site fuel tanks. The Ministry of Business, Innovation and Employment, MBIE, has stated that any decision to upgrade the response level will depend on the evolution of the Middle East situation, with recommendations already submitted to the Minister for consideration. Importantly, there has not yet been a sustained disruption to fuel supply in New Zealand, and the country's current fuel inventory, including in-transit supplies, is sufficient to last approximately 52 days. Channel Infrastructure, New Zealand's largest fuel import terminal, has also confirmed that it is operating normally, providing some short-term stability. Despite this short-term stability, the government is preparing for medium-term risks, including potential ship diversions or export restrictions from oil-producing countries. With order coverage periods limited, officials are engaging closely with importers to assess purchasing capacity in the coming weeks, through May. In a global environment of tight supply, particularly for sources in Southeast Asia, competition for fuel and raw material orders is expected to intensify, further driving up costs and increasing the risk of shortages. On the consumer front, the government faces a difficult policy dilemma. While many consumers are struggling with rising fuel prices, the government has ruled out cutting fuel taxes, arguing that such a measure would stimulate demand and lack targeting. Instead, it is considering targeted subsidies to support households that rely heavily on cars for commuting or essential travel. The Treasury is currently modeling the path of oil price increases and their impact on households, but no specific subsidy has been submitted yet. This approach reflects a balancing act, providing relief to those most affected without exacerbating inflation or distorting market dynamics. This policy caution is rooted in the government's concern about inflation, which is already under pressure from the oil crisis. If the Middle East conflict persists throughout the year, the government forecasts that inflation could reach 3.7% in the worst-case scenario, well above the Reserve Bank of New Zealand's target range of 1% to 3%. While this figure is still lower than Australia's inflation rate, which is facing similar pressures from global energy costs, it represents a significant upward revision from previous forecasts and a potential threat to New Zealand's economic stability. 3. Macroeconomic impacts, inflation, business confidence, and economic growth. The oil crisis is exerting significant pressure on New Zealand's macroeconomy, with inflation, business confidence, and economic growth all facing headwinds. Economists across major banks have revised their forecasts, acknowledging that the conflict in the Middle East has introduced a high degree of uncertainty into New Zealand's economic outlook. 3 of New Zealand's 4 major banks have recently raised their inflation projections, warning that the rate could remain above the Reserve Bank's target for most of the year. New Zealand Bank predicts inflation will accelerate to 3.6% in the second quarter before falling to 2.9% by the end of the year, while ASB forecasts a peak of 3.3% in the second quarter and a year-end rate of 3%. Westpac, meanwhile, expects inflation to reach 3.2% in the third quarter, reflecting the delayed impact of rising oil prices on the broader economy. Kelly Eckhold, chief economist at Westpac, has been particularly vocal about the risks, noting that business confidence is likely to weaken as a result of rising fuel costs. A significant number of people are concerned about the increase in fuel costs, he said during an appearance on Herald Now Business. There is a real possibility. I think business confidence and commercial activity could be impacted for at least a few months. This sentiment is shared by other economists, who warn that the uncertainty surrounding fuel supplies and costs could lead businesses to delay investment, hiring, and expansion plans, further dampening economic growth. Eckhold also revised his inflation forecast, acknowledging that previous expectations of inflation falling to just over 2% may have been overly optimistic. Frankly, some of the recent news makes me wonder if that forecast is too optimistic. Inflation could be even higher, he said. This revision reflects the growing recognition that the oil crisis is not a short-term shock but a potentially prolonged disruption that could embed inflationary pressures in the economy. The second-round effect of rising oil prices, where higher energy costs feed into higher prices for goods and services, leading to wage demands and further price increases, poses a significant risk of a vicious cycle that could be difficult to break. Nick Tuffley, chief economist at ASB, echoed these concerns, noting that New Zealand's economic growth will likely fall short of the initial 3% forecast for this year. The New Zealand economy will still grow this year, but it will not reach the initial 3% forecast because the impact of the Iranian war remains pending, he said during an appearance on the Mike Hosking morning show. If there is a real disruption to fuel supplies, everything could change. This caution underscores the fragility of New Zealand's economic recovery, which is already facing challenges from global economic slowdowns and domestic cost of living pressures. The impact of the oil crisis on global energy markets is a key driver of these economic headwinds. The Strait of Hormuz, which carries approximately 2,000 barrels of crude oil per day, equivalent to one-third of global seaborne crude trade, has become a flashpoint, with Iran threatening to attack energy facilities in the region. A prolonged disruption to shipping through the strait could lead to a global supply gap of up to 1,500 barrels per day, as land-based pipelines in the Middle East can only divert a fraction of the oil transported by sea. This supply gap, combined with OPEC's limited spare capacity, estimated at less than 200 barrels per day, could push oil prices to triple-digit levels, further exacerbating inflation and economic stress in New Zealand. Shipping costs have already surged, with war risk premiums for vessels passing through the strait doubling, and alternative routes such as the Suez Canal adding significant time and cost to supply chains for New Zealand, which imports nearly all of its fuel. These global trends translate directly into higher costs for businesses and households. The average price of 91-octane gasoline has risen to around 2.85 New Zealand dollars per litre, with diesel prices exceeding 3 New Zealand dollars per litre, an increase of nearly 30% since the outbreak of the Middle East conflict. For households, this means higher commuting costs, increased prices for groceries and other goods, due to higher transportation costs, and reduced discretionary spending. For businesses, particularly those in the transportation, manufacturing, and logistics sectors, rising fuel costs are squeezing profit margins and forcing difficult decisions about pricing, hiring, and production. Point 4. Consumer behavior and market adaptations. The rise of fuel price comparison tools. As fuel prices continue to rise, New Zealand consumers are adapting their behavior, with a growing number turning to fuel price comparison apps to find the best deals. Garsby, New Zealand's leading fuel price comparison app, has seen a surge in new users, with its user base approaching 2 million and approximately 5,000 new users joining each day. This surge in popularity reflects the growing financial pressure on households, who are increasingly looking for ways to reduce their fuel costs. However, the influx of new users has brought its own challenges, with a significant increase in incorrect oil price information being submitted to the app. Mike Newton, director of Garsby, explained that the app is introducing artificial intelligence, AI, to identify and correct these errors, ensuring that users have access to accurate and reliable price data. AI can judge abnormal data through context, he said during an interview with Ryan Bridge Today. For example, if someone enters a diesel price higher than the 91-octane gasoline price at the same gas station, AI will use common sense to determine that this is likely an error. Newton noted that most of the incorrect prices stem from user error, particularly as new users familiarize themselves with the app. When there is a large influx of new users, we see a lot of input mistakes, such as filling in the 91-octane price in the diesel column, or mistakenly entering a price starting with 3 as 4, he said. To further combat false information, the app has temporarily disabled its long-distance update function, which prevents users from submitting price data for gas stations they are not near, reducing the risk of intentional misinformation. The rise of apps like Garsby is a testament to how consumers are adapting to the oil crisis, but it also highlights the broader impact of rising fuel prices on daily life. For many New Zealanders, fuel costs have become a major financial burden, forcing them to cut back on other expenses, change their commuting habits, or seek out more fuel-efficient vehicles. This shift in consumer behavior is also having a ripple effect on other sectors, with businesses in the retail, hospitality, and entertainment industries reporting reduced foot traffic as households tighten their budgets. Long-term challenges and opportunities. Building resilience in a volatile world. The current oil crisis has exposed the fragility of New Zealand's economy, particularly its heavy reliance on imported oil and raw materials. While the country's current fuel inventory provides a short-term buffer, the ongoing uncertainty in the Middle East and global energy markets means that New Zealand must confront long-term challenges to build greater resilience. One key area for improvement is the diversification of supply chains. For the plastic industry and other sectors dependent on imported raw materials, reducing reliance on a single region, such as Southeast Asia, and exploring alternative sources could help mitigate future disruptions. While sourcing from regions like the United States comes with higher costs and longer lead times, it could provide greater stability in the face of geopolitical tensions. Additionally, investing in domestic production of critical raw materials. Where feasible, could reduce New Zealand's vulnerability to global supply chain shocks, though this would require significant investment and time. Another opportunity lies in accelerating the transition to renewable energy. New Zealand is already a leader in renewable energy, with hydropower, wind power, and solar energy accounting for a significant portion of its electricity generation. Expanding the use of renewable energy for transportation, such as electric vehicles, hydrogen fuel cells, and biofuels, could reduce the country's reliance on imported oil, lowering its exposure to global oil price volatility. This transition would not only enhance energy security but also support New Zealand's climate goals, creating a more sustainable and resilient economy in the long run. For businesses, the current crisis is a wake-up call to strengthen supply chain resilience. This includes building larger inventories of critical materials, developing relationships with multiple suppliers, and investing in digital technologies to better monitor and manage supply chain risks. For Bonson and other SMEs, these measures are not just a short-term response to the current crisis but a long-term strategy to ensure survival in an increasingly volatile global environment. The government also has a critical role to play in building resilience. Through policies that support renewable energy adoption, encourage supply chain diversification, and provide targeted support to vulnerable households and businesses. While the government's current focus on targeted subsidies rather than broad fuel tax cuts is a step in the right direction, more proactive measures, such as investing in public transportation to reduce reliance on private cars or supporting research and development into sustainable materials, could help mitigate the impact of future oil crises. Conclusion: New Zealand's current oil crisis is a stark reminder of the interconnectedness of the global economy and the vulnerability of small, open economies to geopolitical tensions and energy market volatility. What began as a conflict in the Middle East has rippled across the globe, affecting supply chains, industries, households, and macroeconomic stability in New Zealand. From the plastic industry's struggle to secure raw materials to the government's delicate balancing act between supporting consumers and managing inflation, the crisis has exposed deep-seated vulnerabilities in New Zealand's economic model. Yet, within this crisis lies an opportunity to build a more resilient and sustainable economy. By diversifying supply chains, accelerating the transition to renewable energy, and strengthening support for vulnerable sectors, New Zealand can reduce its reliance on imported oil and better prepare for future shocks. For businesses like Bonson, this means adapting to new supply realities and investing in long-term resilience. For the government, it means implementing policies that balance short-term relief with long-term sustainability. For consumers, it means embracing new behaviors and technologies to reduce fuel costs and environmental impact. The road ahead is uncertain, and the duration of the Middle East conflict will be a key determinant of how severely New Zealand's economy is impacted. However, one thing is clear: the current oil crisis is not a temporary disruption but a catalyst for change. By seizing this opportunity to build resilience, New Zealand can emerge from this crisis with a stronger, more sustainable economy, better equipped to navigate the challenges of an increasingly volatile global energy landscape. As the situation continues to evolve, the actions taken by the government, businesses, and consumers in the coming months will shape New Zealand's economic future for years to come. In the short term, New Zealand must continue to monitor fuel supplies, support vulnerable households and businesses, and prepare for potential disruptions. In the long term, it must embrace the transition to a more sustainable and resilient energy system, reducing its reliance on imported oil and building an economy that can thrive in a world of geopolitical and environmental uncertainty. Only by doing so can New Zealand weather the current crisis and emerge stronger on the other side.